continuing our talk about real world assets and bringing real world assets, RWA, on chain. And now we'll talk about credit. Credit, lending, debt, whatever you want to call it, is obviously the biggest part of financial expansion and financial growth. The whole gist of lending is I need money for some particular thing, whether it's to buy an asset, to start a business, to do something with my life, to do something with business, to do something economically efficient, but I don't have the cash to do it, or I don't want to use my cash to do it. Therefore, I'm going to borrow from someone else and I'm going to pay them something that we call interest for it. That's the basis of lending. And it's so much of what we've already seen in crypto and DeFi. So what do I mean when I say real world assets or bringing real world lending on chain? It can mean so many things. So there are several aspects where we're already seeing it and several aspects where we're going to see real world asset lending, credit, debt, whatever you want to call it, come on chain. And it might take a couple videos to get this across. So one way we see is more kind of DeFi protocols, decentralized finance protocols, where this is actually working. And what this means is there might be a protocol here, and there are several of them. For instance, Maple, Goldfinch, centrifuge and stuff that are these protocols, right? It's just code that is written. And it says that I can connect my wallet and I'm going to contribute, we'll call it USDC, into this protocol, into a pool potentially. And then someone from this pool is going to actually underwrite loans. And the underwriting isn't necessarily going to be done completely on chain. So it's not going to necessarily be you put up $150,000 worth of ETH or something, and I'll lend you $100,000, and it's all completely protocol driven and smart contract driven. It might be something more like a person, somewhat like it happens at a bank or a company, is actually going to underwrite. They're going to determine if they want to lend money to this person or company or group or whatever it might be. And therefore is going to lend the money, and that might be USDC. So it might be USDC in this pool, USDC to the borrower into their wallet, right? This is USDC, which of course there's some smart contract there that says this person is going to repay with interest. And then these people that contributed are going to receive interest, and eventually they can get their collateral or their original investment back out, their principal back out. And in return for putting in their USDC, they'll probably get some sort of token that represents their contribution to this particular pool, and therefore that particular token is going to be used to pay back their interest. So that is the easiest way. But why I call it real world assets is because these loans are going for real businesses or real people, and they might be putting up some degree of collateral. They are likely putting up some degree of collateral, but this is taking money. The reason why this is important is it's taking money that people might have in their crypto wallets, in their DeFi or ETH wallets or something, and allowing all those people to pool money. But then for someone, a person who is good at this, someone who has a history of underwriting loans, of deciding who to make loans to, which are efficient, which we can count on to be paid back, actually making those loans to people that might be using it to operate a business that has nothing to do with crypto. Maybe it has something to do with crypto, but it's not going all completely without human interaction. So these are kind of the real world asset loans that I see coming on board, and that's why I say real world assets. This is why it's important. It's taking money from people all over the world potentially who just connect a wallet and have crypto assets like USDC, contribute those into a pool, and then someone's going to be able to utilize the funds in that pool and lend that money out. And obviously they're going to take a little cut. The borrower's going to pay their interest, and some of the interest gets paid back to the protocol, and then most of it is going to go to those that actually provided the funds. It operates a lot like a bank. To be honest, this is essentially what a bank does. But the difference is now anyone in the world essentially can connect their wallet and be part of depositing in here so that someone else can underwrite those loans. Okay, so that's the first place that we kind of see real world assets in lending, kind of coming together. And it's really important because it's going to open up, there's going to be so many more pools available. Those underwriting pools right now, some of it's going to relatively crypto-related use cases. Some of it's going to people in the developing world who need to borrow money, which is one of the great use cases for crypto and DeFi overall, is get more participation from those all over the world. Some of that money eventually will be pools that go into things like mortgages. They'll go into other types of investments that you and I have never really had the opportunity to invest in, but now we might get to because we can just connect our wallets. But it's all these real world use cases for borrowing that money that are now going to have access to more pools of funds because we don't necessarily have to go through traditional banks or traditional investment companies like that. So that's one place we're seeing real world asset kind of credit. Another, I talked about this before. I talked about when I talked about income streams and the ability, maybe some of those pools that I just talked about will go to funding income streams. And that's when you start talking about things like factoring. And this is where I mentioned centrifuge earlier. Centrifuge is helping to factor loans or to factor income streams, which basically means if I know I'm going to get paid, so let's say I'm going to get paid 1 million USDC in 90 days or something, or there's a 90-day payment period, I might be able to go to some sort of pool over here of funds, and I might say, look, you can have this stream, you can have this payment that I'm going to get in 90 days or over 90 days if you give me $950,000 right now, or 950,000 USDC right now. Now, this is doable. This can happen in a relatively efficient way because maybe this is part of a smart contract. Everything's part of a smart contract such that this company or this pool that provided this $950,000 for $1 million, what we can do is take this stream of money that was going to go here and we just reroute it up here. So now this pool is getting this $1 million over 90 days where they have been out this $950,000 that went to my wallet potentially. Okay, so this is where we see this opportunity for more credit like factoring, for more lending based on income streams, because as I talked about when I talked about income streams as an asset, because of the transparency, because of the ability to move that income stream into another wallet or to wrap it in a smart contract, it makes it an asset. And now as a lender, I can lend against it. And that lending could be me individually, it could be a pool, it could be a protocol, it could be a company, an investment DAO, something like that says this is what we're going to do. We're going to raise money to be able to do this. But because of the transparency, because of the smart contract, the programmability, all of those things, we're able to issue more of those loans. And what happens is more people in the world are able to participate in this way. More companies are able to participate in invoice factoring, and it brings the fees, it brings the costs down so much because we can move everything programmatically. Okay, so another interesting place, super interesting place that we're seeing credit, real world assets and credit is oftentimes, in the past we've seen a company, so we'll call it Apple again. I know I keep going back to Apple. So Apple says instead of raising money in the equity market, we're going to raise debt market, right? And they might raise $1 billion. Okay, so now what happens is if I have, instead of buying Apple stock, I say, look, I'll lend money to Apple. I'm pretty sure they're good for it, right? I'll lend them $100,000. And this is just a loan. This is a bond, basically. That's what I'm buying, right? And so I might get 5% back. So after a year, I have $105,000. Now these get traded. Just Apple loans to Apple get traded, bonds for Apple get traded, just like Treasury bills get traded, just like all sorts of other debt instruments or debt securities get traded now. Right? Once the debt has been issued, now it can be traded. Well, this particular $100,000 that I loaned to Apple that they're going to pay me back, what if I want to trade that? What if interest rates go down or something, and now this is worth more to someone else, and they're going to, they're going to pay me for that? Well, I might want to go sell it on the open market. So what if this particular transaction, we were to make a token out of it that basically encapsulates everything about this particular transaction, and now I can go take that to some marketplace that's on the Ethereum blockchain and say, look, I'm willing to sell this. Does anyone want to buy it? Now, there's already markets for debt, obviously. There's monstrous markets to resell debt over and over, but they're relatively centralized. So this can create a decentralized marketplace. And again, it means more people can participate. There's more liquidity. All of those pieces to it. There's so much transparency that everyone can see what's going on. They can value it on their own. And once we have that ability to tokenize this, now we have the ability to package them into more securities or put them in my portfolio, package more of them in my portfolio, for instance. You might package credit to several different organizations. You're able to see the risk transparently, but I'm lending money to Apple, or I'm lending money to the government, I'm lending money to some municipality or someone else, and then I can create a token for it, and it is so transparent. I can see what's happening all the time. This is really important. I can now have that in my portfolio. I can maybe build a portfolio of those loans, and because they're transparent, I can evaluate the risk of all of them. I don't want to say relatively easy, but there are ways to evaluate the risk such that I might feel more comfortable having them in my portfolio. And therefore, it might not be the purview all the time of huge companies that are doing this, or huge pensions or institutions, but I might be able to do this myself. I might be able to get some help and do this. There might be protocols, or might be systems that help me do this. So this is another instance where real world assets, which is a loan to a company or a loan to a municipality, is going to be used in the real world, not all on chain, but all that can be brought on chain, such that now it's part of the financial system. Now it's part of the decentralized financial system. And of course, once I have this loan, this is now principal plus an income stream. As we've said, I might be able to separate the income stream and the principal. I might be able to get a loan against the income stream, or a loan against the principal, or something like that, because it's an asset that is tokenized, meaning I can take this that's going to be $105,000, and maybe I can go get a loan against that, because again, the proverbial, like, I need to buy a car, I want to pay for my daughter's wedding, something like that. I can go get a loan against it without necessarily selling it or getting rid of it. Or maybe, again, I can go to this marketplace and sell it if I want to at any point. It creates liquidity for me. So these are some of the ways that we're seeing credit, whether it's in the form of lending pools and lending protocols that actually do the underwriting. So they take DeFi money like USDC and go lend it out in very real world ways. Or what we're saying is, let's take real world ways that I'm earning money, or real world investments I have, and providing lending against them. Or take a real world loan, right? I lend money to Apple. I buy a bond, right, from Apple. So I give them money, they're paying me interest. And now I tokenize that and go sell it. And again, because of the transparency, because of the decentralized nature, because of the programmability of it, of smart contracts, now I'm able to get more use out of that, more efficiency, more liquidity, for example, more collateral out of it. I'm able to do all those things because of the tokenization, because we took real world assets and moved them on chain.